Hey folks, in this video, we're going to be highlighting the SPY high volume rebound strategy. This is looking for one specific candle on the daily chart on the S&P 500. And this is a really interesting strategy. This is something that I've been studying for some time now. And I think it's something that I wanted to share with you guys to see what you guys think of it. So let's go ahead, dive in, and let's get started. How does the SPY volume rebound strategy work? What are the rules and what's win rate, all that good stuff. So let's go ahead and start with the psychology of exhaustion. So what happens when price pulls back and is a strong exhaustion candle? So forced action. Huge volume represents panic, selling, stop runs, institutional rebalance, hitting a peak. The floor, the trend line, is an obvious psychological level where the dormant buyers are waiting to step in and supply is running out essentially. So rebound occurs as aggressive sellers exhaust themselves, leaving a vacuum. So it's basically a vacuum to that one specific point. And then basically you are buying the exhaustion at a confirmed structural support. So let's get into the technicals. How are we putting this on the chart? How are we visualizing? How are we getting everything together? So the first thing you're going to do is you're going to go to TradingView and you're going to look up volume candles. So at the top here, you'll see volume candles. You can actually turn those on. And what that's going to do is each specific candle, it basically represents the maximum amount of volume. So the more volume in that candle, the bigger it's going to be. And what I like about it is that you can actually visually see it. And I'm a visual person, especially when it comes to trading. I like to see levels. I like to see where trend lines are drawn, where price is. This is just another little, a little thing that you can add. And it really makes it interesting with the strategy. The next thing is you're going to want to use a daily chart. So the first thing is volume candles. Number two is the daily chart. And then number three is you're going to draw an anchor trend line connecting major price lows. Essentially, you're just going to draw a bottom trend line of it once because S&P 500 notoriously has been going up over time. So there's going to be a trend line at some point. You're going to want to draw those at those lows. And so you can even see that I have a couple trend lines. This one is pointing to one. I believe this was an April low. And but if you need more help on drawing trend lines, I have several videos about it. Go ahead and check those out. But we're gonna mainly just stick with the strategy, and I want you to be able to figure this out quickly because this is a really cool strategy. And then the signal is going to be watch for a massive red volume candle hitting the line. You're going to visually see these. This isn't really something that you're going to be alerted to. You're actually going to have to visualize it on the chart at the end of the trading day. And so the strict strategic entry rules. There's three conditions. Daily volume must be a clear volume candle that you can visually see on the chart. So right here, you see how that candle is a lot wider. It's bigger, it's stronger than the rest of them. It also, price needs to be coming down. This isn't a strategy where it's at the very peak, at the very top. This is when the S&P is pulling back. Okay, so condition B, price must tag or slightly pierce the trend line that you drew. This is a liquidity hunt tactic. And then C, the candle close must not be ugly, ideally closing well off of its lows. And that's kind of like I threw that in there just because there could be an ugly chart and it wouldn't really look ideal for something like this. You're going to want to just pass on that entry. And then, so the entry, once you get the big red candle into the trend line, you're going to buy the next morning open after the big red volume candle. That's going to be the main way to do it. Or you can do it a little more risky and buy at the very bottom. So at the very bottom candle, so you see that on the right here, you can actually buy rate. That's going to be a little more risky, but that'll give you a little cushion. But the idea behind this is because if it does close below, sometimes this will trigger a market, basically a market reversal. So that's a little more risky. That's why we like to trade it at the open. So at the open in the candle. So essentially we opened right here. So this would have been the buy. So that would have been the up buy entry. I probably should have drew that there. Avoid if price closes and sustains below the trend line. Yeah. So if the next day it opens lower, it continues to go lower. Not really something like, say something right here. This was a nice candle, but it opened lower. But it did come back in, but then it did come back. It did continue to go down, and there wasn't a trend line right there. So that really wouldn't have been what we're looking for. We're looking for a bounce. This is a trend line bounce strategy, essentially, with extreme volume. And so, yeah, so the best setups follow 3 to 5 consecutive days of red into the support zone. So yeah, support trend lines. This is really good. Good way to put it. Right here is literally the best example possible. I should have had where the trend line was drawn, but essentially you're just connecting the dots. You're putting at a low, and then you're putting at a, and then you're drawing, because there was a reason for this trend line, but essentially that is where you want it, and that's the exact entry. We opened right here, and then it just continued to move up. Let me actually see if I can find that. Let's actually go on the SPY chart, and let's actually go ahead and find that example, because I think it's important to kind of be a little more transparent. So yeah, so this is the let me put this up on the chart here. Okay, so this is our entry, right? This was our trend line. So so basically with trend lines, you're gonna put the lower low. So this is the lower low here, and you're gonna connect it to the next one, and then you're just gonna draw that thing out. And so right here, you would have drawn it, or you would drew the trend line, and so you're gonna just be all this time you'll be waiting for this strategy. So this isn't really like, so this was from June all the way to, well, I guess there wasn't too long from then. You're waiting for that pullback. You're waiting for that big, you see these two big red candles. This was a really strong red candle. And then this was the gap down red candle. So this would have been a really nice entry. And I guess the target here would be more, a little bit higher. There's different rules with this that I was really kind of testing out. One was getting in. I like to be a little more risky with this strategy. So I like getting in at the very end of the day. And then you could just target the highs, or you can even just continue to just let it run, right? Let it run to the next resistance zone, which is where this would be up here. So this would be a beautiful options trade if you're getting in with options, which is what I like to do with these as well. But anyway, so that's the example. That's where you saw this candle right here. But I just want to just kind of show that to you on the chart, that we can kind of see it as well. You're just drawing a trend line, and it's bouncing off of that trend line with a big, thick red candle. Think about just a nice, solid red candle, and you want to see that take place. All right, so risk management, defensive stops, place stops below the trend line and the low spike candle. So you can have, if you're doing an option, you can either just let your option run, or even just let it go to a specific percentage loss. To me, with options, with this strategy, I really like to target $1 to $2 options and just let it run. I mean, if it's a loss, it's 100%. If it's a gain, you're looking at 2, 3, 4, sometimes 500%ers, right? And so that's kind of the name of the game. And just you're going to want to kind of just think about it in terms of that. And when I say 100% loss, you don't necessarily need to wait for it to be 100%. The price just goes sideways, and you're in a 7 to 10 day option. You're going to want to get out of that and you'll probably lose 50 to 60%, maybe a little bit more. But that's kind of the idea behind it. Is this isn't really a strategy where you're getting in and you're just you're hoping that it'll just kind of just go up over time. No, this is a strategy where you want to get in and you want it to bounce quickly and strong, and which is typically what happens. And with that, you can grab a SPY option that is, like I said, around $1 to $2, which will be a little bit out of the money, but it'll be big money. It'll be really big wins, and it'll just be it'll do really well. So that's kind of the idea behind that. With the trade, you can even just do you can just buy the stock outright. You can just buy SPY. whatever. But the name of the game is you want to get in at the right level and then get out at the right level. All right. So, and which, with that being said, profit targets, right, prior day high or the previous major swing high. So in our example, we're targeting the major swing high, which is right here. So if we got an option, that was a few days out, let's just say we have a 10-day option, 1, 2, 3, 4, 5, so we're not even close to where our option would expired. And say we got a $1, $2. I mean, that would have been a big. I wish I could have. I probably could do it to show you just how massive these options would be. But you can do options, or like I said, you can do shared, which is not a very big move in some cases because the SPY doesn't move. This is more of an options. Get in now and to get a really strong big win under your belt. So that's kind of the idea behind it. Tell your stop. You can tell it with a moving average if you want. That's kind of more optional. To me, I just like to let it run up to that previous resistance zone. Okay, and then this is our example target. So we could have gotten in down here. So this, like I said, that I like to do more aggressive, but you don't have to be that aggressive. You can get in at the next day open and then let it run. So that would have been a really nice trade. And then, like I said, with the option, and I could give you the exact option if you guys would like. To me, this strategy is more of the entry, and then I can maybe do an additional video at some time where I'll specifically dial in what option to select. But the option I would select would be anywhere from 10 days out. You could do longer, but and then around $1, $2, which will be significantly, it'll be out of the money a little bit. But the idea is to get those really from $1 to $1,000, right? Those are the trades that we want. Those are the trades that we're looking for with the specific thing. So this is more of a riskier strategy, but it does pay off big time. The VIX peak. This is just kind of a charting example. What's happening, so that the VIX is going to be spiking along with it, so you can look at the VIX. I don't really care about, in this specific thing, the VIX is important, but with this strategy, we really just need the chart and we need the trend line. We don't really need to look at the VIX, but that's what's going to be happening with the VIX. It's going to be going up at that time, and then it's going to be the volume spike and then the price support. So that's kind of the magic formula behind it. The probability of success. This isn't really. I wouldn't really put all your I won't put everything into these, but just a kind of a small back test with this. Your win rate is jumping up a good amount from 42 to 68 with just highlighting the high volume spike with trend line. So normal volume with trend line, you're looking at about 42. And again, these could go either way depending on where you're getting in, where you got out. Did you hold your option? Did you not hold it? RSI oversold is a 51%. Yeah, that could be the case as well. But these are just more. This is kind of just more to get you an idea of it. This is not going to be a 100% win rate. This isn't going to be a 90. This is probably even going to be an 80 or 70. Yeah, you're looking more around 50 to 60s. But with that, you're really looking to target those big money trades. And I'm talking, like I said, I'm talking about $1 to $1,000 options trade, which will be, a $1 option to a $10 option essentially. So that's a 1 to 1,000. So that's kind of the idea behind it. And so the additional volume outlier increases strategy expectancy of 26% compared to the base trend line. Again, I won't put all your marbles into that win rate, but it will definitely increase it with the trend line. Get a little quote here: trade the panic, not the noise. Volume is the only indicator that cannot be faked by market sentiment. You cannot fake volume when there's a lot of volume, when there's a lot of things happening. Big moves occur. So that's the idea behind the strategy. If you guys want to know a little bit more about it, I really just wanted to focus on the entry. And then now, since I'm really going into it and thinking about it, you guys might want to know more about like what options specifically. So I can highlight that in maybe another video if you guys want, if this strategy is interesting. I found it interesting, and I think I'm going to be, utilizing it anytime we get a trend line bounce with really strong volume, which we could be coming into very soon at this specific time. So, all right, guys, that's it for me. And if you have any questions about the strategy, let me know in the comments below.